Hi everyone, I am William. Welcome to this channel and thank you for joining me here. If you found this channel is useful, please feel free to subscribe to this channel and switch on the notification function. Today, we're diving into a complex, fascinating, and critical area of modern finance, the audit of structured products. If you think auditing a standard bond or equity portfolio is challenging, structured products are a whole different ballgame. They are, by design, engineered instruments, bundles of derivatives and cash assets tailored to specific risk-return profiles. And where there's complexity, there's heightened risk. Our role as auditors is not to be mathematicians, but to be forensic navigators. Today, I will provide you with a practical framework for auditing these instruments, focusing on the key risk zones where auditors must shine their light. First, let's align on what we mean. Structured products are prepackaged investments built from traditional assets, like a stock or bond, combined with derivatives, often options. Common examples you'll see in portfolios include principal-protected notes. Your capital is safe, but returns are linked to an index's performance. Auto-callables. These can mature early with a premium if an underlying asset stays above a certain level. Reverse convertibles. They offer high coupons but expose you to the downside risk of a reference asset. The common thread? They transform market risk into combinations of credit risk, liquidity risk, and highly path-dependent payoff risks. Your audit client might hold these for yield enhancement, speculation, or hedging. Understanding the why is your first clue. So, why is this audit so specialized? 3 core challenges. 1. The black box problem. The exact formula for the payoff can be buried in a 100-page term sheet. The complexity often obscures the true economic risk. 2. Valuation is model-dependent. Unlike a listed stock, there's no single market price. Value is determined by internal models, fed with assumptions about volatility, correlation, and interest rates. Garbage in, garbage out. 3. Asymmetric information. The product manufacturer, often a large investment bank, has a significant information and modeling advantage over the buyer and, by extension, over us, the auditors. Our job is to bridge that gap. Your audit begins long before you look at a number. Phase 1 is all about comprehension. Step 1. Deconstruct the term sheet. This is your Bible. You must identify the issuer, credit risk, the underlying assets, the precise payoff formula, the maturity, the barriers or triggers, and all fees. Create a simple diagram. What drives the payoff? Step 2. Interview management. Why did they buy this? Yield enhancement is a common answer. Probe deeper. Does the stated purpose match the product's risk? Is it a hedge? If so, test its effectiveness. Step 3. Assess competence. Does the team managing these products have the expertise? This is a key control in itself. This is the heart of the audit. Valuation. We focus on 3 pillars. Pillar A, inputs integrity. Where do the model inputs come from? Volatilities, correlations, dividends, interest rates. They must be sourced independently from the trading desk. Test a sample by tracing them to Bloomberg, Reuters, or independent pricing services. Verify the closing prices of the underlying assets on valuation dates. Pillar B, model governance. Is the model, often a Monte Carlo simulator or a closed-form solution, approved by a model validation group? Request the validation report. Even if you can't rebuild the model, you must understand its key limitations and assumptions. Has it been benchmarked against the provider's quote? Pillar C, independent price verification, IPV. This is crucial. Management must have a process to challenge their own marks. Audit their IPV process. Do they get periodic quotes from the originating bank or other counterparties? How are discrepancies resolved? Your substantive test. Obtain independent third-party quotes for a sample of products. Expect a range. Investigate outliers. Value is one side of the coin, risk is the other. Risk, disclosure, and reporting. Do the risk reports sent to management and the board accurately reflect the risks? A delta or beta equivalent might hide the explosive gamma risk in a barrier option. Scrutinize stress test and scenario analysis reports. Do they show plausible, severe scenarios, like a volatility spike or a correlation breakdown? Hedge accounting and documentation. If hedge accounting is applied, the documentation standards are rigorous. Test for timely documentation and ongoing assessment of effectiveness. Operational controls. Confirm the product is captured completely in the booking system. Verify reconciliations between front office risk systems and the general ledger. Check that all contractual payments, coupons, fees, have been made, received correctly. Now, we map our work to the core financial statement assertions. Existence and ownership. Confirm holdings with the custodian. Review legal agreements. Completeness. Ensure all products are recorded through system reconciliations. Valuation. Our entire Phase 2 work supports this. Rights and obligations. Who owns the economic benefits? Review contracts. Presentation and disclosure. This is often a significant issue. Read the footnotes. Do they clearly explain the nature, risks, and valuation techniques of the structured product portfolio? Are sensitivities of fair value to key assumptions disclosed? The notes must tell the true story. Be alert to these warning signs. Consistently favorable, IPV, where the internal value is always at the top end of the bid-ask quote range. Products from a single, less creditworthy issuer. Complex products held in entities without demonstrable expertise. Inconsistent or missing hedge documentation. Your toolkit. Patience, a skeptical mind, and specialized skills. Don't hesitate to use a valuation specialist. Your role is to design the audit procedures, understand the specialist's work, and evaluate the results in the financial statement context. To wrap up, auditing structured products is about systematic skepticism. Remember this three-part mantra. 1. Understand the economics. Never audit what you don't comprehend. Deconstruct the product. 2. Challenge the valuation. Focus on inputs, model governance, and independent price verification. This is your core substantive procedure. 3. Verify the story. Ensure risks are properly measured, reported, and disclosed. The numbers and the narrative must align. You are not expected to be a quant, but you must be a robust challenger of the process that produces the numbers. Thank you for your attention. This is a dense field, and I've aimed to provide a practical framework. If you found this video is useful, please do share it out with your friends and colleagues, and feel free to subscribe to this channel. Thanks again and have a nice day.